I've genuinely been looking forward so much to doing this video. Right, quick question. If a financial advisor sat across from you and said, do you want to pay less tax? It's totally legal. What would you say? Most people would say yes. Jimmy Carr said yes. He wasn't wrong to say yes. The problem came later. In June 2012, the Times ran a story. 1,100 people had been channeling their income through a Jersey structure, receiving it back as loans and paying almost no tax. The arrangement was called K2. The people using it had been told it was legal, and they believed it. One of those 1,100 people was one of Britain's most famous comedians. The same one who earlier that year had done an entire television segment mocking the kind of person who uses a tax scheme to pay approximately 1% tax. The Prime Minister found out, and this went badly. Subscribe now, because the reason this story matters for you has nothing to do with Jimmy Carr and everything to do with a rule that came into force the following year that changed what legal means in UK tax law. Let's do the mechanics, because understanding what K2 was is the only way to understand why it worked and why it stopped working. K2 was promoted by an accounting firm based in Kirkcaldy. The shell companies that made it run were in Jersey, and the structure, once you strip it back, is simple enough. To explain in 30 seconds, you are a high earner. Instead of receiving your income in the normal way, in which case income tax at 45% and national insurance apply, your income is paid to an offshore company. The offshore company sits in a trust of which you are a beneficiary. The trust then loans you the money. You have the money, you are spending the money. But technically, you have a loan, not income, and loans are not income. Income tax applies to income. Therefore, no income tax. £168 million across 1,100 people, not just Jimmy Carr, 1,100 people who had all been told by an accountant this is legal. And here is the part that makes this story complicated and worth understanding. At the time, they were told that it probably was. Tax avoidance, using legal structures to pay less tax than the Treasury would prefer, has always been legal. What it has not always been is permanent. On the 20th of June 2012, David Cameron was at a G20 summit in Mexico. ITV News asked him about K2. He had clearly had time to think about his answer. He called the scheme morally wrong. He then went further specifically on Jimmy Carr. I think this is completely wrong. People work hard, they pay their taxes, they save up to go to one of his shows, they buy the tickets, he is taking the money from those tickets, and as far as I can see, is putting all of that into some very dodgy tax avoidance schemes. The following day, Jimmy Carr posted a statement on Twitter. In full, it read, I appreciate as a comedian, people will expect me to make light of this situation, but I'm not going to in this statement, as this is obviously a serious matter. I met with a financial advisor and he said to me, do you want to pay less tax? It's totally legal. I said yes. I now realise I've made a terrible error of judgment. Although I've been advised the K2's tax scheme is entirely legal and has been fully disclosed to HMRC, I'm no longer involved in it and will in future conduct my financial affairs much more responsibly. Apologies to everyone, Jimmy Carr. Note what is in that statement. He says the scheme was entirely legal. He says it was fully disclosed to HMRC. He then says it was a terrible error of judgment anyway. All three of those things can be true at the same time. That is the core of this story. Now, the same week, 4 members of Take That were revealed to have invested £66 million in a separate scheme called Icebreaker. Similar structure, different vehicle, same idea. They were eventually ordered to repay around £20 million to HMRC. Gary Barlow kept his OBE. David Cameron did not call him completely wrong on television. Draw your own conclusions. Here is why K2 matters beyond the celebrity angle. In 2013, Parliament passed the Finance Act 2013. Buried inside it was Part 5, the General Anti-Abuse Rule. GAAR works like this. Before it existed, the test for a tax arrangement was, is each individual step legal? If yes, then the overall effect was legal. Tax law operated like a lock. If you had the right key for each mechanism, the whole thing opened. GAAR introduced a second test. Is this arrangement something a reasonable person would regard as reasonable? Not, is it technically legal, but can it reasonably be regarded as a reasonable course of action in the context of relevant tax provisions? The technical phrase is the double reasonableness test. What this means in practice, if your arrangement exists solely to manufacture a tax advantage and no sensible commercial reason would lead someone to structure things this way otherwise, HMRC can challenge it, regardless of whether each step was individually legal. The key detail, GAAR, only applies to arrangements entered into after the 17th of July 2013. The K2 users were in the scheme before that date could not be challenged under GAAR retrospectively. But the lesson for everyone structuring their affairs after that date is this: technically legal is no longer the whole answer. Here is your mid-roll question. Do you think there is a real difference between tax avoidance and tax evasion? Is the outcome the same regardless of what you call it? One word in the comments, I'll read everyone and I'll reply to you. One more thing. Earlier in 2012, Jimmy Carr had done a sketch on Channel 4's 10 o'clock live. One more thing. Earlier in 2012, Jimmy Carr had done a sketch on Channel 4's 10 o'clock live about Barclays Bank's tax arrangements. Arrangements which had resulted in Barclays paying an effective tax rate of approximately 1%. He wasn't sympathetic to Barclays. At the time of broadcast, Jimmy Carr's effective tax rate under K2 was approximately 1%. I'm not going to pretend I have something original to add to this. Every newspaper said it first. What I will say is that there is something useful in it beyond the irony. Tax avoidance at this level is not a character defect. It is the rational response to a system that for decades created gaps and rewarded the people who found them. Carr was not unusual. He was just more recognisable than the other 1,099 people in the scheme. The problem is not that he tried to pay less tax. The problem is that the mechanism he used was one that 3 years later a new rule would have been able to challenge. He was playing by rules that were about to change. And then there is the Cameron footnote. In April 2016, the Panama Papers were released. Among the clients of Mossack Fonseca, the Panamanian law firm at the centre of the leak was a fund called Blairmore Holdings, founded in 1982, never paid UK tax, run by Ian Cameron, the Prime Minister's father. David Cameron had sold his shares in Blairmore in January 2010, 4 months before he became Prime Minister. He paid no capital gains tax. The profit fell within his annual exempt amount, all legal. He didn't call himself completely wrong on television. Right, you were almost certainly not running an offshore trust with 1,100 other people. But the pattern behind K2, redirect income, receive it back in a different form that looks like something else, turns up in smaller versions all the time. I'm even asked about it by clients all the time. The director version looks like this. You extract money from your company through a mechanism your accountant describes as aggressive but legal. The structure technically works. Each step has a legal basis. The overall effect is that income has been reclassified as something that attracts a lower rate. Post GAAR, the question HMRC now asks is not just, is each step legal? It is, would a reasonable person regard this overall arrangement as a reasonable course of action? If the only commercially rational reason for the structure is the tax saving, you would not have done it otherwise. The arrangement is vulnerable. £3.2 billion in a single year from settlements. The machine HMRC runs at this is not small. What holds up is not clever. It is structure that was built for a commercial purpose, where the tax efficiency is a consequence of doing things properly, not the sole reason for the structure existing. If your current arrangement would embarrass you in a letter to HMRC, that's worth addressing before HMRC writes the letter first. That is the K2 story. 1,100 people, one comedian famous enough for the Prime Minister to address by name from Mexico. One rule introduced the following year that redefined what legal means in this space. If you run a limited company and you want to know whether your current structure passes, not just the is it legal test, but the would HMRC consider this reasonable test. The link is in the description. Apply for a strategy review at apply.ctprivateoffice.com. We look at the whole picture. We do not take everyone, but if this conversation made sense to you, you are probably the right kind of person. Like this video if it changed how you think about tax avoidance versus tax planning. It costs you nothing and it tells YouTube to put it in front of more people who need to hear it. Subscribe if you haven't. The next video is the one I teased in the farms and pubs episode. And yes, the maths on both is genuinely bad. Drop your one word in the comments, avoidance or evasion. Is there a difference?